Crypto Market Review Today Market Wrap, Bitcoin's price and Ether's dominance sit at 2020 highs. Bitcoin's price is at its 11-month high as volatility bounces back up. Meanwhile, Ether's dominance has spiked on continued growth in decentralized finance (DeFi). Bitcoin (BTC) trading around $10,998 as of 2000 Coordinated Universal Time, 4 p.m. ET, gaining 2.1% over the previous 24 hours. Bitcoin's 24-hour range, $10,573 to $11,422 BTC above 10-day and 50-day moving averages, a bullish signal for market technicians. The price of Bitcoin hit another 2020 high Tuesday, reaching $11,422 on spot exchanges like Coinbase. The last time the price of the world's oldest cryptocurrency hit that level on Coinbase was August 12, 2019. Bitcoin has pushed decisively through not only psychological resistance of $10,000 but also a key level near $10,055, said Katie Stockton, an analyst at Fairlead Strategies. However, she is skeptical the price can stay over $11,000. There are some signs of upside exhaustion on this push higher, so we would be sure to await confirmation of the breakout before adding exposure to Bitcoin. This would occur on consecutive weekly closes above $10,055, she added. The Fear and Greed Index is in the extreme greed zone, moving towards the overbought level, noted Konstantin Kogan of cryptocurrency fund of funds BitBull Capital. The first support is located at the level of $10,000. If Bitcoin falls below this mark, then there is a possibility of a subsequent decline, he added. Not all stakeholders are suspicious of the Bitcoin market's price run-up. One positive for traders is that volatility is making a comeback, according to data from aggregator Crypto Compare. Historical Bitcoin volatility has bounced from its lowest point since March 2019, said James Lee, research analyst for Crypto Compare. The question is whether this is just a temporary bounce or are we heading back to a historical, more volatile BTC market, he added. Ethereum dominance hits 2020 high. The second largest cryptocurrency by market capitalization, Ether, ETH, was down Tuesday, trading around $318 after slipping 1.5% in 24 hours as of 2000 Coordinated Universal Time, 4 p.m. ET. The dominance of Ether in the cryptocurrency market crossed 12% Monday, its highest point in 2020, according to data calculated by real-time charting firm TradingView. Dominance, or the market cap as a percentage of the entire cryptosphere, is a measure traders use to quickly get a sense of a cryptocurrency's importance relative to the broader digital currency market. Although Ether's dominance has dipped below 12% Tuesday, it's still higher than it has been all year. The last time Ether hit 12% dominance was back in May 2019. DeFi users can access that market using stablecoins. But clearly the main core asset fueling the DeFi run is still Ether. Hence its recent dominance, said Jean-Marc Bonfils, managing partner for Tellurian Capital, which has been investing in crypto projects since 2014. The recent development and ramping up of new and better DeFi applications such as Compound, Aave and Balancer is clearly generating more traction for Ethereum. He added, how real is Bitcoin's rally? 8 interpretations of Bitcoin's massive surge. As Bitcoin retraces slightly after reaching a new 2020 high about $11,000, NLW explores what's driving the BTC rally and how likely it is to continue. It was a beautiful Monday. Bitcoin crashed through $10,000 and got all the way up to a new yearly high of about $11,000 before retracing slightly. As with any dramatic price action, people were quick to start giving their interpretations of why it happened. 8 ways to understand Bitcoin's massive surge. Banks stacking due to changes in custody rules. Money printer Go Burstock to flow model. Robinhood traders piling in. DeFi gain. Recycling buyers exceeding sellers. Perfect storm. Dollar crash. Negative real interest rates and the search for a new reserve currency. Ultimately, NLW argues that it is this last factor driving up not only Bitcoin but gold and silver. Why Bitcoin-like scarcity would be a disaster for the dollar. Francis Coppola, a CoinDesk columnist, is a freelance writer and speaker on banking, finance and economics. Her book The Case for People's Quantitative Easing explains how modern money creation and quantitative easing work, and advocates helicopter money to help economies out of recession. There's a widespread belief that the exorbitant quantity of money the Federal Reserve is pouring into the U.S. economy must eventually mean the return of high inflation. After all, if there's lots more money but no more stuff to buy, prices must rise, mustn't they? So the prospect of Judy Shelton, known for her support of the gold standard, joining the Fed's Board of Governors is raising the hopes of those who want the Fed to be stripped of its money creation powers. But the Fed's mandate is price stability. And, as I shall explain, if the Fed can't vary the quantity of money in circulation in response to economic circumstances, it can't stabilize the price of a dollar. What is the price of a dollar? Some people like to express the dollar's price in terms of gold, though as the dollar hasn't been backed by gold since 1971, this is perhaps a bad attack of nostalgia. For them, the dollar's price is anything but stable and the Fed is fatally undermining it. Gold bugs think the rise in the dollar price of gold over the last century means the dollar is worthless, despite me arguing about it with them for hours. I have had similar arguments with people who think that massive rises in the stock market, bond market, real estate, Bitcoin mean the dollar is hyperinflating. But as the dollar is not backed by assets, the rising price of assets tells us absolutely nothing about the price of a dollar. For ordinary U.S. people and businesses, the price of a dollar is its purchasing power. The dollar's domestic purchasing power is the quantity of U.S. goods and services U.S. residents can purchase with their own currency. The rate at which the dollar's purchasing power changes is known as the inflation rate. If people reject a currency in favor of gold or another currency, its purchasing power falls to zero. This is known as hyperinflation. It has never happened to the U.S. dollar. If the Fed wants the price of dollars to remain stable, it has no choice but to accommodate that demand by creating lots more dollars. For foreigners, the price of a dollar is its exchange rate versus their own currency. The exchange rate is the quantity of another currency that $1 can purchase. This in turn determines not only the quantity of externally produced goods and services that U.S. residents can purchase with dollars, but also the quantity of U.S. produced goods and services that foreigners can purchase with their own currencies. We can therefore regard the exchange rate as measuring the dollar's purchasing power outside the U.S. A fall in the exchange rate means $1 purchases fewer foreign-made goods and services. The rate at which the exchange rate falls is thus the external equivalent of the domestic inflation rate. Exchange rate collapse destroys the external purchasing power of the currency, just as hyperinflation destroys its domestic purchasing power. Indeed, the two are often seen together. If the country has large amounts of debt denominated in foreign currencies, exchange rate collapse can mean it becomes unable to service these debts. Furthermore, if the country is dependent on imports, a sudden exchange rate fall can mean it can't pay for imports. All too often, the government's response to these disasters is to print enormous amounts of its own currency in the hope of exchanging it for the foreign currency it needs. This fuels the exchange rate collapse and triggers domestic hyperinflation. In the past, central banks and governments regarded the exchange rate as the most important price. They thought countries must earn their way in the world by exporting goods and services to other countries, and they knew controlling the exchange rate would help them to export. They also feared that if a country allowed its exchange rate to float against other currencies it would collapse, resulting in hyperinflation. So they pegged their currencies to gold or other assets, or even to each other. Fear of floating determined monetary policy long after the end of the gold standard. Indeed, for many developing countries it still does. As recently as the 1980s, the Fed was actively managing the dollar's exchange rate, aided by other central banks. But after the failure of the Louvre Accord in 1989, the Fed switched to managing the dollar's domestic purchasing power instead of the exchange rate. Along with most major central banks, it set a target of 2% per annum consumer price inflation and allowed the exchange rate to float. Since then, the Fed has managed inflation by adjusting the interest rate it charges banks to borrow dollars. Bank lending creates purchasing power. Increasing banks' borrowing costs encourages them to charge more for loans to individuals and businesses, which damps demand for loans and thus reduces bank lending. When bank lending falls, the rate at which purchasing power increases also falls. In other words, less bank lending means lower consumer price inflation. Of course, U.S. banks create dollars when they lend. But the Fed doesn't directly control the quantity of dollars they create. And it doesn't restrict its own money creation either. It creates reserves in response to demand from banks, and provides liquidity to financial markets in response to signals from market participants. Contrary to popular opinion, this is intended not to allow inflation to run out of control but to maintain it at around the Fed's 2% inflation target. To understand why the Fed can't meet its price stability mandate by directly controlling the quantity of dollars in circulation, it's helpful to look at Bitcoin's behavior. Bitcoin's algorithms control its quantity, not its price. The quantity of Bitcoin in circulation increases at a constant rate and is ultimately limited to 21 million, even though this won't be reached in the lifetime of anyone alive today. The result of controlling the quantity of Bitcoin rather than its price is price instability. Bitcoin's price is subject to wild swings as demand for it fluctuates, while its quantity does not. This roller coaster ride doesn't really matter for Bitcoin, because almost no one is buying their weekly shopping with it or hodling their life savings in it. But for the millions of people whose livelihoods depend on the dollar, price swings of the kind all too often seen on the Bitcoin charts would be disastrous. As we saw in September last year and March this year, international demand for dollars heads for the moon at times of crisis. So if the Fed wants the price of dollars to remain stable, it has no choice but to accommodate that demand by creating lots more dollars. This would still be true if it were targeting the exchange rate, by the way. International dollar shortages cause the dollar's exchange rate to rise. If the Fed adopted some kind of algorithm that kept the rate of money creation constant, or linked the dollar to gold or some other asset, the result would be renewed instability both in the dollar's external value and its domestic purchasing power. Not on the upside, exchange rate collapse and hyperinflation really are not a serious risk. But on the downside, we know from the 1930s that when the Fed is prevented by a rule or a gold standard from creating enough money to ease a crisis, the result is debt deflation and severe economic depression. Let's not go there again. What crypto lender Celsius isn't telling its depositors standing in a spacious, white living room and sporting a black t-shirt? Alex Mashinsky, CEO and co-founder of cryptocurrency lender Celsius Network, urged his customers to ignore the naysayers. Don't listen to the fudders, look at the facts, Mashinsky said on the YouTube livestream on July 17, using crypto slang for fear, uncertainty and doubt. A few minutes later, he reassured the audience of Celsians, as the platform's users are nicknamed, that the company is prudently deploying their crypto deposits. Like a bank, Celsius borrows from one set of clients, lends to other customers and pockets the difference in interest. Unlike a bank, it only borrows and mainly lends cryptocurrency, and it does not have government deposit insurance. The company claims to have gathered a total of more than $1 billion worth of crypto deposits as of June. As an example of its high lending standards, Mashinsky said Celsius strictly demands collateral when making a loan. When you're using any other platforms that are like Celsius, what you care about is, who is the borrower? Mashinsky said, is the lender doing non-collateralized loans? Celsius does not do non-collateralized loans. Celsius will not do that because that would be taking too much risk on your behalf. The statement was at odds with what Celsius' own representative had told CoinDesk just a few days before. In response to a question from CoinDesk, Anastasia Golovina, an external spokesperson for Celsius at the Ditto PR agency, confirmed the company also makes uncollateralized loans, on what she described as a limited basis. Celsius' total uncollateralized loans are less than a fraction of 1% out of tens of thousands of loans issued since 2018, Golovina told CoinDesk by email on July 13, referring to the number of loans but not the dollar volume. All of these were normal-size loans and were done to institutions with billions of dollars in equity. When subsequently asked about the dollar volume of the uncollateralized loans and about Mashinsky's denial of their existence on the AMA, Golovina did not provide a response. Even if small, the uncollateralized lending is one of several salient items that Celsius has downplayed or not shared with depositors. Hot Ticket Celsius is a major player in a budding corner of the crypto industry. In the past year, lending activity has mushroomed as some holders sought to earn a yield on their assets, others sought to raise cash without selling their coins, and market makers borrowed to fill orders quickly. The phenomenon could potentially improve liquidity and price discovery for crypto assets. Disclosure: another crypto lender, Genesis Capital, is owned by Digital Currency Group, which is also the parent company of CoinDesk. But like all lending, the crypto kind carries risk, and Celsius may be taking more of it than depositors fully realize. Whatever the amount of unsecured lending in which Celsius engages, the majority of Celsius loans appears to be collateralized. To borrow $1,000 with a 0.7% interest rate, for example, a trader needs to pledge around 0.43 BTC of collateral to Celsius as of this writing, and if the value of that collateral dips, the loan is subject to margin calls. But Celsius has also at times invested deposits in perpetual swaps, futures-like contracts with no expiry date, people familiar with Celsius business said. Reportedly pioneered by the BitMEX exchange, perpetual swaps settle to an index periodically, letting traders maintain their positions without rolling them over. This activity, one source said, increases Celsius' vulnerability to brutal sell-offs like the one Bitcoin endured in mid-March, which led to a spike in forced unwindings of such contracts at BitMEX. The problem is that some of that is done on BitMEX, and you take March 12 again and BitMEX closes down through the margin call floor. The extra 2% profit is now negative 10% profit, this person said, describing a hypothetical scenario. Celsius denied investing in perpetual swaps. Our business is to lend out coins to institutions, Mashinsky said in an email to CoinDesk. Celsius lends mostly to large institutions and sometimes to exchanges, both provide us with collateral. Rehypothecation: a serial entrepreneur who helped pioneer voice-over Internet Protocol (VoIP) technology, Mashinsky founded Celsius in early 2018. Like many in the crypto space, he touts his service as a way to democratize finance. An August 2019 pitch deck obtained by CoinDesk says the company's vision is to provide fair interest income for 7 billion people. Also potentially concerning to depositors, people with knowledge of the matter said, is that Celsius lends out portions of the collateral borrowers hand over. An over-the-counter desk trader likened this practice, known as rehypothecation, to the way subprime loans were repackaged and sold as mortgage-backed securities and then resold as collateralized debt obligations in the years leading up to the 2008 financial crisis. Because of rehypothecation, which the trader said several crypto lending platforms are engaging in, he is seeing many clients pull out of lending and move toward options contracts. Another source familiar with Celsius business said the lender's rehypothecation of loan collateral is also why crypto miners don't take out loans from the firm they don't want to end up unable to access crypto they mined. In response to questions about rehypothecation of collateral, Golovina said Celsius won't discuss our best business practice and the competitive advantage of our business model. In its terms of use, Celsius reserves the right to rehypothecate customers' assets, but it's ambiguous whether the passage refers solely to depositors' funds or to borrowers' pledged collateral as well. In consideration for the rewards earned in your account and the use of our services, the document says, you grant Celsius the right to pledge, repledge, hypothecate, rehypothecate, sell, lend or otherwise transfer or use any amount of such digital assets for any period of time. Shrunken Capital: Celsius raised its startup capital through an initial coin offering (ICO) in early 2018. The company swapped its CEL token for Bitcoin (BTC) and Ether (ETH), the largest and second largest cryptocurrencies by market capitalization, respectively. However, Celsius did not convert the crypto it had received to fiat until after the market tanked, which caused it to lose about half the value of the proceeds, people familiar with the sale said. Public information supports this claim. In September 2019, Mashinsky told CoinDesk the ICO was valued at $50 million. But its financial statements filed with the UK Registrar Companies House in May 2020 show sale proceeds of only $25 million as of February 28, 2019. Celsius is based in Hoboken, NJ, and privately held, but has a subsidiary in London, and is thus required to file financials with the registrar. Celsius chalked up the difference to an accounting practice, but acknowledged it did not convert the crypto to fiat in the same month that it was raised. While Celsius reported an ICO worth $50 million, when the coins converted to fiat the value of the coins dropped as the market dropped in accordance, Golovina said. In addition, for tax reasons, we recognize revenues over several years as we use the funds to build the product. Celsius recognizes ICO proceeds as revenue only when it converts the funds to dollars, she said, again citing tax reasons. It waited to convert the crypto to dollars because the firm identifies as a HODLER, she added, using crypto argo for a long-term investor. In the last 2 months, Celsius raised close to $30 million, consisting of $18 million crowdfunded on BNK to the Future and $10 million from stablecoin issuer Tether.